Welcome to this explainer. Today, we're diving right into the nuts and bolts of a massive transition in the global economy. We're talking about how private startups transform into absolute public powerhouses. Whether you're an investor, an entrepreneur, or honestly just kind of fascinated by how capital markets actually work, wrapping your head around this evolution is absolutely essential.
So think about it. Every ambitious startup eventually hits a wall and faces this ultimate question to unlock their next stage of massive growth. How do we actually go public? Well, it's not just a single one-size-fits-all path anymore. Today, companies have this really sophisticated toolkit of distinct strategies, and each one comes with its own unique architecture, advantages, and of course, some pretty serious trade-offs.
To break this all down, here is our agenda. First, we'll look at the foundation, then the traditional IPO. After that, the direct listing. Next up, the SPAC fast track. And finally, the Showdown.
All right, Section 1, the foundation. Before we get into the weeds, we have to understand that the financial arena is basically split into two distinct markets. On one side, you have the primary market. This is where a company actually creates new shares and sells them for the very first time, literally injecting fresh cash directly into its reserves. On the flip side is the secondary market. This is where, once issued, those shares just trade among investors. Investors are buying and selling to each other, and the company itself, it doesn't make a single dime from those trades. Honestly, keeping this distinction in mind is the single most important factor for us to understand the differences between the three pathways we're about to explore.
And overseeing all of this action is the ultimate referee, the U.S. Securities and Exchange Commission, the SEC. Their mission is totally paramount, which is to protect investors and maintain fair, orderly markets. Before a single share can be sold to the public, the SEC steps in and enforces some seriously strict due diligence. We're talking massive registration documents, plain English disclosures about a company's financial health, their risks, the whole shebang. They essentially set the non-negotiable framework for any legitimate path to going public.
Let's open door number 1, the traditional IPO.
The absolute heavyweights of the IPO process are the underwriters. These are specialized investment banks acting as the principal intermediaries. And they aren't just sitting there giving advice. They actually purchase the newly issued shares directly from the company itself, and then turn around and resell them to the public. By doing this, they're stepping up and assuming the massive initial financial risk of selling the entire block of shares to the market.
Now, the timeline here is, well, it's a grueling marathon. It all kicks off with a totally meticulous internal audit, followed by actually hiring those underwriters we just talked about. Next comes the SEC's really intense scrutiny of what's called a Form S-1. And finally, the company's executives basically go on tour. They embark on this exhausting global roadshow, pitching to huge institutional investors to build an order book and eventually set that final share price.
But here's the crucial point. While this traditional route definitely offers proven stability, it comes at a really steep price. Underwriters charge a fee, known in the biz as a spread, and that typically eats up a staggering 7% of the total capital raised. To put that into perspective, for a billion-dollar offering, that is tens of millions of dollars just walking right out the door in fees before the company even rings the opening bell.
Plus, there's a pretty huge catch for the founders and early investors. They're subjected to a strict lockup period, usually lasting about 180 days. This is a legally binding agreement that strictly prohibits them from selling their existing shares right out of the gate. And why do they do this? Well, it's to prevent a massive wave of insiders cashing out, overwhelming buyer demand, and basically crashing the stock price on day one.
All right, moving right along to door number 2, the direct listing.
In a pure direct listing, the company just applies directly to an exchange to have its existing shares authorized for public trading. It's a very deliberate sidestep of traditional Wall Street norms. It was used brilliantly by tech giants like Spotify. By letting their existing employees and founders sell their current shares directly on the exchange, the company prioritizes immediate liquidity for its people. And the best part, because they aren't issuing any new shares, they pull this off without diluting their overall equity base.
This really highlights the core mechanical difference between these two models. In an IPO, that initial pricing is kind of set behind closed doors by underwriters building up a book of orders. But in a direct listing, the price is discovered totally organically through a pure open market auction on the very first day of trading. It's literally just individual and institutional buy and sell orders dictating the opening value, which offers this completely unfiltered level of transparency.
Now, the pros here are obviously incredibly appealing. I mean, 0 underwriter fees? That saves the company millions. Plus, you get a much faster timeline and pure market transparency. But you've got to weigh the serious cons. Without an underwriter there to stabilize the stock, you can expect some severe, wildly unpredictable price volatility on day one. And traditionally speaking, this route raises absolutely 0 fresh cash for the company's actual operations.
Okay, let's open door number 3, the SPAC Fast Track. The mechanics of a SPAC, or Special Purpose Acquisition Company, basically invert the whole traditional model. Instead of a private company out there looking for money, a SPAC is essentially just a massive pile of public cash sitting in a trust account, actively hunting for a private company to acquire. It's kind of wild when you think about it.
This completely flips the chronological script. First, the sponsors form a shell corporation and run their own blank check IPO just to raise public funds. Then, the clock starts ticking. They typically have a strict window of up to 2 years to hunt down a promising private target. Once they find that golden ticket and the shareholders approve, they execute what's called a de-SPAC merger. And just like that, the private target is transformed into a publicly traded entity.
But to ensure they actually have enough cash to close that massive merger, sponsors often arrange something called a PIPE. That stands for Private Investment in Public Equity. It essentially brings in committed, third-party institutional capital right at the finish line to bridge any potential funding gaps. The SPAC Fast Track offers, well, incredible speed. We're talking going public in just 3 to 4 months. And it comes with guaranteed valuation certainty because the price is fully pre-negotiated. However, the drawbacks can be pretty severe. SPACs have been heavily criticized for massive promote fees awarded to the sponsors, extremely high shareholder dilution, and historically, much weaker investor protections compared to the rigorous oversight of a traditional IPO.
Which brings us to Section 5, the Showdown. This matrix right here perfectly synthesizes everything we've talked about. Really, it all comes down to a company's primary objective. If you're a mature company needing massive capital for global expansion and you're okay with high costs and a slow timeline, the traditional IPO is definitely your gold standard. Now, if you're a well-known, profitable brand that just wants to give immediate liquidity to your loyal employees quickly and do it at a low cost, you go with the direct listing. But if you're an innovative company looking for the absolute fastest route with a guaranteed pre-negotiated valuation, the SPAC merger is your strategic shortcut. Ultimately, these aren't just interchangeable financial terms. They are deeply strategic decisions that reveal a ton about a company's financial health and their core priorities. As the capital markets continue to evolve at lightning speed, it leaves us with one really fascinating question. Which path will the next generation of industry disruptors choose to unlock their public future? Well,